The precious metal space is of great interest at the moment for a number of reasons, and we're watching as well the relationship between gold and silver. This is the gold to silver ratio. During the summer of last year, this was at 120. That's the number of times that silver goes in to the price of gold. And where are we now? Well, we're at about the mid-60s. So what's brought this about, and how, as traders and investors, do we benefit from this? Let's pick up now with the fund manager from the Junior Gold Fund, Angelos Damaskos, one of our regular guests here. Angelos, good to talk to you again, and thanks indeed for joining us. Indeed, we were talking last summer about this gold to silver ratio when it was around about 120, and here we are now down around about the mid-60s. First of all, remind us what the gold to silver ratio is and what it tells us about the market.
Yes, Jeremy, good to be on the show again. Thank you for inviting me. And I very vividly recall our conversation last summer in July when we were speaking about the silver ratio reaching an all-time high of over 120 times, and that it could potentially revert back to the long-term mean average, which is in the region of 60 times. That is the price of silver going into the price of gold. Now, as we mentioned, as we discussed a few months ago, silver has the tendency to lag or lead the development of gold price. And typically, it lags in a bull market environment, the development of the gold price between 6 to 12 months. And this seems to have happened again since the middle of last year, when silver caught up with gold effectively in the latter half of the year, and the ratio reverted back to the current 68 times. And we saw silver dip in the COVID-induced sell-off in March down to $11 or $12 an ounce, and then rebounded very quickly and very, very rapidly to just over $30 that we have seen. We saw back in August, and then we saw it again a couple of weeks ago. So there seems to be the similar correlation, the historical correlation at least, of gold and silver seems to be holding true so far. And I would like to point out that over the last 30 to 40 years, the gold to silver ratio has dipped well below 40 times. So it could do this yet again. And if we are right about our expectation that gold will again test the recent all-time highs we saw a few months ago of $2,000 an ounce, gold could easily test its previous all-time high, which was $50 an ounce, and we saw that in 2011.
As a fund manager, of course, you deal with stocks, but you also deal with some of the fundamentals in the market. What is it fundamentally that is driving the price of silver? We know from experience that silver is more steered towards the industrial metal end of the market. Of course, gold has a little bit more of just a precious metal sort of end to it. But silver does have this industrial side to it. From the fundamental point, what do you see as the big issues? Is it not necessarily the industrial side? Is it demand and supply? Is it simple economics that's driving the price?
Well, in fact, Jeremy, a very interesting supply-demand pattern has emerged in the last couple of years for silver. And according to major data producer suppliers like the Silver Institute, we can see that in the last couple of years, the primary supply of new mined silver has dropped by about 5% to about 830 million ounces a year. Whereas the demand, because of the increased interest in photovoltaics, the increased interest in technology applications such as memory chips, and the drive to electric vehicles, electrification in general, alternative energy, all of these have increased demand for silver, which is a superconductor of electricity and is particularly applied for microchip technology and other industrial applications. But most importantly, photovoltaics. So, solar panels need a lot of silver in their production. So demand has actually risen by 2% in the last year to 990 million ounces a year. So there seems to be a primary deficit between new mine production and demand. And effectively, the world is drawing on existing inventories and recycling of old stocks. And if this situation continues, there will obviously be a need to develop new mines and new production. But this, as we all know, takes years.
As I said, you are primarily a fund manager and you look after investors' money in this particular sector. And of course, you are interested in individual stocks. Of your picks at the moment, what is it that you are focusing most on in terms of individual stocks to watch?
Well, we like the so-called brownfield projects, Jeremy, the projects that were either past producing or are on a fast track to restart in production, because we think these are going to be the growth engines of the industry. They will provide new primary production, but also they become very attractive takeover targets by larger companies who seek to replenish their production pipeline and their growth prospects. So we have focused at the moment in our junior gold fund. We are weighed approximately 1/3 of the portfolio into silver miners, and among those, most of them are the so-called brownfield producers. And two names I want to mention are one is a company called Arcana Silver, which trades in Toronto, and has recently fully funded to production its Revenues Virginius mine in Colorado, which could come into production in the next 12 months or so. And that will be a major boost to the company's free cash flow generating capacity. And yet its share price at the moment undervalues this potential future production coming on stream. So even though the company has performed extremely well over the last year or so, we believe that it has a lot further to develop in terms of the share price valuation in relation to the fundamentals. And this is currently the top holding in our junior gold fund. Another one that is of particular interest to me is a company called Silver One Resources that controls a past producing mine in Nevada called Candelaria. And this project suspended production in 2013, I beg your pardon, because of the drop in silver prices. The company is currently drilling to increase the resources and reserves and is progressing towards a feasibility study, which means that the project could come on a fast track to production again. So these are the type of projects that we think are probably the sweet spot in the market. Projects that can come into production in the next 2 to 3 years and therefore become the growth engines of the industry. And particularly in the current environment, I believe that the middle capitalization companies that are generating record amounts of free cash flow at current metal prices, are looking for new growth opportunities. And the growth is not going to come easily from exploration, which takes years to develop the production. It could come from the so-called brownfield sites.
Look, it's a pleasure to be able to catch up with you again. Thanks indeed for joining us with this look at the silver to gold ratio and a couple of your picks in the silver space as things stand in this early part of the year. Angelos, it's good to talk to you. Thanks indeed for joining us there from London. That's Angelos Damaskos. He's the fund manager of the Junior Gold Fund. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.